Welcome to Big Picture Earnings Analysis.
Today, we are jumping right in.
We're unpacking Credo Technologies, that's CRDO, their Q2 results, and the incredible forward guidance that just set the stock soaring.
And this wasn't a standard report. This was, well, something else entirely.
It really was. So this news dropped for the period ending November 1st, and the market reaction was just immediate.
Oh, absolutely. The stock jumped, what, nearly 12.5% in extended trading?
Exactly. It signaled that this wasn't just a slight beat, but maybe a massive acceleration in their core business.
Right.
So let's start with those headline numbers, the ones everyone was watching versus Wall Street.
Okay.
Analysts were looking for adjusted earnings per share of 49 cents.
And Credo delivered 67 cents per share.
67. That kind of gap is what immediately gets everyone's attention.
It is, but I think the revenue performance was maybe even more impactful.
Okay, let's hear it.
They reported revenue of $268.03 million. Now, you have to compare that to the consensus forecast,
Which was where?
sitting at about $235 million.
Wow. So they cleared it by over $30 million.
They did. That kind of gap tells you that the analysts' models were fundamentally too low. They missed something big.
So let's unpack what was underneath that beat. Because the dollar figures are one thing, but the growth rates tell the real story here.
This is where it gets pretty wild. When you look at the raw growth, this isn't some small incremental thing.
Right.
Credo's revenue grew a remarkable 272%.
Year over year.
272% year over year. I mean, just think about that number for a second. Even sequentially, quarter on quarter, it was up 20%.
So the CEO, Bill Brennan, he must have been pleased.
He called them the strongest quarterly results in Credo's history. You just don't see that kind of acceleration unless a company is hitting a major turning point in its market.
That kind of hyper-growth is, that's what everyone's looking for in this sector.
Mm.
For those of you who really track the financials, let's talk for a second about GAAP versus non-GAAP, because that's always a key detail with these high-growth tech companies.
It's a critical distinction. So for the quarter, Credo's non-GAAP net income was $127.8 million.
And the GAAP number.
The GAAP net income was $82.6 million.
And that difference is usually things like stock-based compensation, right?
Exactly, non-cash expenses. For a fast-growing tech company that's using equity to attract top engineers, the non-GAAP number can give you a clearer picture of the actual operational profitability from sales.
And what's interesting is they did this while keeping their margins really strong.
Incredibly strong. The non-GAAP gross margin hit 67.7%.
And to maintain margins in the high 60s while your revenue just grew almost 300%, that's just highly efficient execution.
It speaks to really strong operational control. And you have to look at the balance sheet, too. They ended the quarter with $813.6 million in cash and short-term investments.
That's a war chest.
It is. It gives them so much flexibility for R&D, for acquisitions, for anything. It lets them get really aggressive in defending their market position.
Okay, so with over $800 million in the bank, the next question is obvious. Why? Why is demand spiking like this right now?
And the answer is pretty simple. It's all about AI.
Right.
The CEO pointed directly to the continued build-out of the world's largest AI training and inference clusters. This is the arms race we see among all the hyperscalers.
And this is where we have to clarify what Credo actually does, because they aren't making the GPUs that get all the headlines.
No, they're providing the critical connectivity tech. We've called it the plumbing before, and that's a good way to think about it. It lets all those powerful chips talk to each other.
Efficiently.
Efficiently and reliably. That's their mission. In these massive AI data centers, it's not just about speed anymore. It's about power consumption. Every single watt you can save is a huge advantage.
So their technology is all about high-speed Ethernet. We're talking speeds like 100G, 400G, 800G, and now even looking toward 1.6 terabits per second.
Insane speeds.
Yeah.
And the way they do it comes down to their proprietary silicon. It's their foundation.
And that would be the SERDES and DSP tech.
That's it. Serializer, deserializer, and digital signal processor technology. That's their technical moat. It's the engine that lets data move at these speeds over cables without errors or, drawing a massive amount of power.
And this core technology then feeds into their main products, their ICs and AECs, which are driving these results.
Correct. The ICs are integrated circuits, the actual chips that go on the boards in servers and switches.
And AECs.
Active electrical cables. These are so important right now. At these higher speeds, a normal copper cable gets really bulky and needs a ton of power. Credo's AECs embed their silicon right into the cable itself. It lets the data travel further, using way less power than the old solutions.
So they're essentially making the wiring smart.
Exactly. It's a technology that is perfectly timed for this hyperscale AI build-out, where power efficiency is just as important as raw speed.
So the AEC and IC products are what's driving growth now.
Right now, yes. But the CEO also made a point to highlight what's coming next. The pipeline is strong.
Okay, so what are these new solutions?
They're expanding out from just the cables. We heard about upcoming ramps for things called zero-flap optics, ALCs, and OmniConnect gearbox solutions.
What does all that mean?
It means they're trying to own every layer of the high-speed connection. Not just the cable, but the components that switch and manage the data at those future 1.6 terabit speeds.
That roadmap, plus the Q2 beat, that brings us to the forward guidance. And honestly, this might be the part that lit the biggest fire under the stock.
This was the jaw-dropper. So for the third quarter, which ends in January, Credo is expecting revenue to be between $335 and $345 million.
Okay, let's just sit with that number for a second, because the analyst consensus for Q3, where was that before this announcement?
The street was at $247.6 million.
Wow. So they aren't just raising guidance, they're guiding almost $100 million higher than the consensus at the low end.
It's a total reset. They're effectively rewriting what everyone thought was possible for the rest of the fiscal year.
And they're expecting to do it profitably.
Right. They're guiding for non-GAAP gross margins to stay very healthy, between 64 and 66%. And they're keeping operating expenses in check. It shows confidence that they can scale this fast without losing control.
And the CEO said this outlook of strong growth extends through fiscal 2026 and beyond.
Which tells you management believes this isn't some one-time blip. They think this is the start of a new, sustained, higher growth rate.
But I have to play devil's advocate here. A 272% growth rate. That's just not sustainable forever for any company.
That is the absolute key question every analyst is asking.
So is there any risk that this is just demand being pulled forward from future quarters?
It's possible. But the argument for sustainability is that product roadmap we just talked about. They have new products like ZeroFlap and OmniConnect ready to ramp up after this initial AEC and IC wave.
So they have another act ready to go.
They seem to. And if you believe that the demand for AI infrastructure itself is here to stay, then Credo's role as that essential plumbing remains strong. Now, that 272% will definitely come down. Of course it will.
Right.
But the market is betting it settles into a new, much higher normal, not that it collapses.
So that leads us to the broader market context. The immediate commentary was, as you'd expect, pretty excited.
Oh, yeah. The phrases we saw online were things like insane growth and a lot of praise for the beat and raise. It shows genuine surprise at how big the numbers were.
And there was that interesting piece of commentary about their position in the ecosystem, the idea that they're bundled with the big chip makers like NVDA and AMD.
Yeah, that insight is critical. Because if it's true, it changes their risk profile completely.
How so?
It means they're not just some optional component. They become a vital, embedded part of the big AI sale. When a hyperscaler buys a whole rack of servers, Credo's technology is just in there by default.
So when the big players win, Credo wins.
Exactly. But with this kind of explosive growth, you always get skepticism, especially around the stock's valuation.
The other side of the coin.
Right. We saw some positive articles before earnings, like Credo stock is a buy. But now the concern is summed up in headlines like AI momentum vs overvaluation.
Right. The stock has run up so far, so fast.
And maybe the most telling comment I saw was that for Credo, a traditional DCF model, a discounted cash flow analysis, doesn't work on this one.
Because you can't model it. The growth assumptions just broke the spreadsheet. The future is too uncertain.
Precisely. It suggests the stock is trading on a narrative of massive growth potential, not on something you can easily plug into a financial model.
Okay, so wrapping this all up for you. Credo delivered an absolute monster of a quarter, driven by that insatiable demand for AI infrastructure. They crushed Q2 and then raised their Q3 guidance by a massive amount.
And it all comes back to that core CRDO technology that powers their essential AEC and IC products, with a new pipeline of solutions coming online right behind it.
So what's the final thought we should leave people with?
Well, what's really fascinating to me is how their financial strength now becomes a weapon. They have over $800 million in cash and this expanding portfolio. So the question is, what kind of competitive barrier does that create for rivals who are trying to get into this market, especially as we head towards 1.6 terabit speeds? And maybe the even bigger challenge for Credo itself is,
What's that?
How do you successfully manage market expectations when you've just posted a 272% growth rate?
Yeah.
That rate will inevitably normalize, and managing that transition will be the key thing you should be watching next.